Hello, everyone. Welcome back to the channel. This is Fair Value Finder. And today we are taking a look at ASML Holdings, ticker ASML. This is a stock that has been on the move. I think I'm up 60% on my position, and I actually closed it earlier today because it's just moved too much. When you look at the numbers, analyst price targets are 1,200. It's currently trading for 1,400. Bought in at $700. Originally wrote it up to 1,200, sold out, bought back in for just under 1,000, wrote it back to 1,400 and sold out again. So that's been my story on this stock because it seems to be one of those momentum stocks. They specialize in chip fabrication machinery, so are a beneficiary of the AI boom. But part of my thesis for selling out, aside from the fact that it's super overvalued, is that the market's starting to penalize companies for high capex. We saw Microsoft and Amazon, and I know Google is way down today as well. I'd have to see if that was related to their earnings and capex, but basically, if you say you're going to spend a lot of money, the market isn't as sure about the return on investment as it was a few months ago. So a company like this, like an Nvidia, are going to start to see repercussions of that. I feel like Nvidia is a little different. It broke 200, was there for a little bit. I had a target of 205 on it. Never really hit the point where I was like, I need to sell out of it. And then it plummeted back down below my average cost. I bought more and now it's back up. I'm up on my position again. So I bought the dip on that. This one, I'll wait for another good dip. If it dips to 1,000 again, I'll probably buy. My target here is actually only 940. But the thesis, if this plays out, you're looking at returns about 17%, so market beating returns for sure. And I mean, if you look at the retained income model, 1,375 there for that. But let's look at all the fundamentals, see how this thing is as a company, not just a name and the story, because all parts are important. And then we'll take a look at the chart and see why I decided to sell out. So earnings are definitely low. I mean, 2.86%. What you're paying, you'd want $70 in EPS, and what you're actually getting, almost 25 last year, almost 30 expected for this year, and 36.7 for next year. Cash flow yield had a good year, almost 34% on average, almost 28. Dividend yield about 0.5% on average, 0.87. Again, that can be an indicator that it's a little overvalued because the dividend yield's almost halved from their average. Dividend is not awful. I definitely feel like they've got room to grow it. They've been all over the place with it, I believe. Yes. Jump up in 2023, pulled it back a little in 24, back up in 25. So I could look into the policy there. It's not really a dividend stock, it's a growth stock for sure, but they might be doing some sort of like profit sharing payout rather than standard dividend. Once they hit a certain level, excess is paid out in a form of a dividend. ROE looks incredible, 49%, skewed a little bit. Balance sheet not really in the shape that we like to see, but their return on investments and assets are both pretty good at 17.4 and 19%. So like a little bit more debt's not the end of the world, especially since they need machinery, what they deal in. So you're probably taking on some debt that you're going to be paying off over time, and you're getting decent returns on that. Gross margin of about 53, 51 and a half on average. Net margin 29, not quite 29 and a half, and on average 27.8. PE currently of 48.2. and a earnings growth rate of 25%, which puts you at a price to earnings growth of 1.92. So again, that shows that it's probably overvalued. You want to see that closer to 1.5 for something like this. Probably not too bad, but when you're approaching 2, it's getting overextended. If you're getting a 16 for your growth rate, I'd give you at best a PE of 30. And that is what I have in for the numbers. The 35 on average is what we're seeing out of them. I think 30 is fair for the returns that you're looking to get. Maybe you can bump it up a little bit more. I can make this 32, which is going to help with some of the metrics and take our fair value up to 944. So again, if you can get sub 1,000 on this, I feel like you're in a pretty good spot. It's been there. It's been $578 within the last 52 weeks, and it's been almost 1,500. So that tells you the volatility of this thing. When we get to the thesis, the last 2 years haven't been too hot. Last 3 years have been pretty good, though. 15.5. Analyst projections are 13.5 and then 15.4. So somewhere around 14 seems to be fair for our thesis. Share count, they are buying back shares. 0.6% is right about what they're consistently doing. Cash flows, I don't think they're going to come in higher than their revenues. I mean, if we take a look at the cash flow history, had a really down year in 2023. Otherwise, they're pretty consistent. And it does look like 12% is fair for that consistency. So that'll put them at a yield of 30.2% in 5 years, which is still super solid. So I don't see an issue with that. Assets, 11.5 to 12.5. So 12 is definitely fair. They're in that range. Liabilities were up over the last few years. So we can go to the higher end of this range. I mean, that's going to pull the valuation down a little bit, but 6 is right in the middle of it, 6% per year. I do like that the assets are growing faster than liabilities with how they are for debt to equity. Dividend, like I said, not consistent at all. I'd like to see them come in at least 4%, 3-4%, beat out inflation, reward shareholders a little bit. And if they can do that, they'd have a dividend of $8.50 in 5 years. And buying at today's price, $8.50 would give you a 0.6% dividend yield. So another sign, it's probably super overvalued right now. And then margins, nothing crazy is likely to happen there. Just some small efficiencies over time takes you up less than a percentage point. All of that gives you average returns of 16.8%, which is pretty good. Factor in that dividend that you're getting, 17.3%. You are beating out the market. We look for 8 to 10%. 17 is basically 2 times market returns, as long as you can get in at the right price. And the story makes sense. But like I said, the story's starting to look weak and the price is not right. Like if you buy at today's price, even with market outperforming growth, you're looking to underperform the market in 3 years. Like if the share price approaches the fair value, in 3 years, this thing fundamentally will be worth $1,070. You can add a premium to that, but that's what the business will be worth. And in 5 years, that's 1,395. So it's trading at essentially its 5-year valuation right now. So if it continues to trade at such a premium, in 5 years, you might be looking at something more like 1,600, which is $200 higher than what you're paying today. And That's not a crazy return whatsoever. $200 on a $1,400 investment. Definitely other stocks that you can get a better return on. So, what if you get in at the fair value? So, I would wait for this thing to draw back down and try to get in around 1,000. That's what I'm looking for myself. So now if we go over, well, we hit a peak right about 1,500. This thing has just been on a absolute run for quite some time. I mean, if we try and find the base of this run was back in about mid 2025. So it's been on a run for almost a year. Just gradually picked up. Topping out just about 1,500. Now, I like to look at moving averages specifically. So what I'm seeing on this one, usually I look at the 50-day moving average. 50-day moving average is currently $1,223. And if we look 60 days, 1,185, 120 days, 1,058. So what I'm seeing here is kind of an inverse head and shoulders. Like you have your shoulder, you came down, you come up, and it's at this resistance point. Like, look, we opened here, closed here, opened down here, closed up here. Same point that you would open the day before. And then this one was a little bit lower out of line. But that candle lines up almost perfectly with those. So I'm looking for tomorrow, another flat day or a down day. Start pushing down, retesting the trend and down to the moving average. So 1,300, 1,200. It ran up so fast, it's got quite a move that it could make. Like the first retracement level would be 1,142. So it could drop down to that level pretty quickly. Ideally, I'd like to see it do a 50% retracement. It saw some support, came down, tested that 50% retracement back in December. And that's probably around the point that I had sold out was here, and I bought back in around there and rode this push up. But that push up definitely seems to be stalling out. We'll watch it. I don't know that there's any momentum for it to continue. MACD might cross over. The bulls might take over, but the RSI is already showing that it's overextended. So I'm looking for MACD to flatten out and continue. Look at this volatility is crazy. Up basically at the threshold right there. That gray area, that's kind of the peak, the extreme zone. So volatility is going to normalize. The stock's going to normalize a little bit at these higher levels and trend down is what I'm seeing off of this chart. And the fundamentals are telling me the same thing. This thing went on a massive run, is overextended, and is due to come back to reality. And I'm positioned for that. So that is what I'm seeing with this one. There might be a trade doing like a call credit spread on the north side of 1,500. Something like this. News can definitely move the stock, and essentially any news in the microchip AI world can move this one. And it's international, so currency fluctuations can have a bigger impact on it as well. So I wouldn't really trade this one unless you had like just balls of steel, unless you have the cash and there's any volume at, let's say this 1,000, this 50% retracement, 1,025. If you could sell a cash secured put there, that might be a trade that I would take. I don't know about you guys, but I'm not putting $100,000 towards a single position, at least not right now. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.